Okay guys, so welcome back to the channel. I hope everyone is doing good. So I'm making this video on valuation just before the test so that in case you just want to summarize and revise valuation once, you can refer to this. If your concepts are clear, I would say it's okay not watching this video. You can refer to the other video where I solved a few sums. In this video, I'll just be covering firstly bond valuation and a few examples. So if you want to revise from the base, this will help you. Okay. So firstly, let's start with bond valuation. So what is a bond? Firstly, so bond is an instrument where there's a coupon rate. So for example, there could be a instrument. So let's say this is a bond, okay, and it says that okay, this is a 11% bond, which is of 100 rupees. So what it essentially means that on the 100 rupees bond, you'll get 11 rupees per year. So it's like a debt instrument. So you get 11% interest on that bond every year. And there are two kinds of bonds. One could be a redeemable bond, one could be irredeemable bond. So irredeemable bond is which does not, you don't get back the money, that 100 rupees that you gave, and you get that money till perpetuity. And redeemable bonds are those bonds where you get their money back after a period of say 5 years, 10 years, 12 years, whatever. So that is also mentioned on the bond. Now, bonds are not really as popular as stocks. So even though the bond market is quite big, but it's not as popular as stocks. So that's why you might not have heard the term bond. So how do you value a bond? So you, for any asset that you want to value, you value that on the basis of the present value for the future cash flows. Okay, so the bond is giving you, let's say, 11% interest every year, and it's a 100 rupees bond. Okay, so every year you get 11, 11, 11, 11, and at the end of the fifth year, let's say, you get that 100 rupees back because it's a redeemable bond. So so this 11, 11, 11, 11, 11, and the fifth year you get 100 rupees extra, so 111. You take the present value of all these amounts, and whatever you get the present value, that is the value of the bond today. So that is the price that you should pay for a bond. Now the bonds, there are three concepts. One is called the issued at par, which is at 100 rupees. So if the bond is, the value of the bond is 100 rupees, like the face value of the bond is 100 rupees, and it's issued at par, that means it's 100 rupees, the bond value is 100 rupees. If it's issued at a premium, in that case, let's say it's issued at a premium of 5 rupees. So instead of 100 rupees, it's issued at 105 rupees. Or it could be issued at a discount, which is 100 rupees. So 95 rupees, maybe it's issued. Now, how will you as an investor value that bond? So you value that on the basis of present value. And for the present value, you'll use the discounting rate. And that discounting rate is the rate at which your cost of capital or required rate of return, whatever you might call it. So the required rate of return that you want to earn from that bond, you discount it using that required rate of return. Okay, so now let's get into one very easy sum so that you get the hang of the entire valuation. So let's say we have a bond of 100 rupees, which has a return of 12% every year, and the cost of capital, or let's say instead of cost of capital, I'll write required rate of return, right? So let's say the required rate of return on that investment for you is 15%. So how do you value that? So it's a 100 rupees bond and 12%. So every year you get 12 rupees, and then in the last year you get that 100 rupees back as well. So that gives you 112. You discount it on the basis of the 15%. So PVIF, present value of that at 15%. So it calculated 1 by 1.15 to the power. So in this case, first year, so 1 to the power 2 to the power 3. So when you do it in Excel, you can either, I've done a complicated formula over here for the exam purpose. You can directly do 1 divided by 1.1 equal to 1 divided by 1.15 to the power, and then link it with the year. In that case, you'll get the same value. I just you linked it to here so that in case you want to change the formula, it will still work, but you don't have to do that for the exam, right? Now, once you multiply this PV of the at 15% with the cash flow, you get the present value of the cash flow, add them up, and you get the value of the bond. So this is the value that you should pay. So this is the price of the bond. It give me an error. Yeah. So this is the price of the bond that you should pay. So even though the value of the bond, so the face value of the bond, I'll write face value over here. Even though the face value of the bond is 100 rupees, you should ideally pay 89.94. Now see what happens if I change my required rate of return to 12. So this is another relationship that's taught us in class. So if the bond is giving 12% and your rate of return is 15%, so you obviously want to earn more than what the bond is giving. So in that case, that's why the price is lower. So you're making up that difference using you're buying that bond at a lower price and then making up that difference through that difference in the price. Now, if this was 12, what would happen? So if this was 12, if I press enter, this should also come to value of the bond should come to 100, because it's exactly at the same level at which the return on the bond and the required return that you want. So it's should be 100, and you can see it's 100. Now, if my required return was 10%, so I require only 10% on my investment, whereas the bond is giving me 12. So I'm getting a lot more than I want. So in that case, I'm willing to pay a extra. So I'm willing to pay a premium on that bond. So if I put 10% and I press enter, you'll see that the value of the bond will go up and will go above 100 rupees. In this case, it's 107.58. Okay. So that's something that mentally, when you solve a sum, when you see that the return on the bond is 12% and the required rate of return is lesser, in that case, you can just mentally, you can make a note that, okay, if the required return is lesser than the return on the bond, then I'll have to pay more than the face value. Okay, so let's go back to the original question, right? So I hope this clears all the doubts regarding the basic bond valuation. Now let's go on to a much more complicated sum. So let me just move these questions up. Yeah, so the first question says that a 100 rupees value bond bears a coupon rate of 11%, will mature at the end of 5 years. The value of the bond, what is the value of the bond if the discount rate is 15%? So this is very similar to what I showed you right now with the last question. So let's not go into that. As far as the valuation is concerned, as calculation is concerned, for the exam, you can directly write 11 over here and 111 over here, even though ideally you can link it and everything, but let's not go that far into all the linkages for the exam. Here as well, you can directly use 1 by 1 plus b1, and then or you can directly write 1 by equal to 1 by 1.15 and then equal to this divided by 1.15. That will give you a rate. You can use that rate. Another thing, let's get to the next question and see. Okay, so I think the second question will also be the same. It's just given you 7 years and then 2 discount rates. So you can expect something question of this kind. Okay, now another concept that we have is called the yield to maturity. Now, yield to maturity is basically, let's say, let's read this question. So market value of the bond of a 1,000 par value bond carrying a coupon rate of 12% and maturing after 7 years is 750. So you can buy that bond for 750. What is the yield to maturity? So in the last question, what we were doing is we were calculating the price. So that is fine. You can do that. Now in some cases, what happens is that price is not negotiable. Here you've not been given the required rate of return that you can earn on the bond. Given said that, okay, this is a 1,000 par value bond, it will give you 12% every year for 7 years, and then at the end of the 7 years it will be redeemed at 1,000 rupees. But today you can buy that bond for 750, right? So what is the yield to maturity of that bond? Now yield to maturity can be calculated using the YTM formula. or the IRR formula as well. So let's calculate this. So what I've done is for the year one. So firstly, you'll pay back. So it's a negative value because so let me just, yeah. So in the 0th year, always remember IRR when you're doing IRR. Always the first cell that you choose is 0 year. So in the 0 year, you'll pay money to acquire that bond. So 750 is the price of the bond. So 750 you pay. Then every year you get 12% on that bond. So 12% of 1000 is 120. Okay. And so on. In the last year, you get 1000 extra. So 1000 plus 120, that's your entire cash flow. Now, if you kind of find the IRR of this entire investment, we get the let's say the YTM of the so if you find the IRR of this investment, so you can use the IRR formula equal to IRR. I'll do it again, equal to IRR, and then select the entire thing, and then just put some rate. If you don't want to put a rate, you can just close it and press enter. So it's saying that 18.67. So again, you can see it's a 1000 rupees bond. I am paying only 750 for it. That means my required rate of return should be higher than what the coupon rate of interest is. If I was paying, let's say 1200 for the bond, then I'll show you. See, if I was paying 1200 for the bond minus 1200, so my IRR would fall below my coupon rate. So here my coupon rate is 14%. You see, when I put that, the coupon rate will fall below 14%, 8 point something. So you can see everything is linked. So you just have to use the IRR formula over here, and then using the IRR formula, you can verify this, but you don't need to do that. Essentially, see what's coming. So you can see the sum is close to 0. So basically that shows that, okay, my entire calculation was correct. So you don't have to do that. You just have to find the YTM and use that. This just to verify, right? Okay. So moving forward, okay, another concept that Sir taught us was semi-annual interest paying bonds. So some bonds might be instead of paying your interest at the end of the year, the bond might give you the interest at the end of the half year. And let's say it can give you the interest at the end of each quarter. It can give you the interest at the end of each month. So if it's a, let's say, semi-annual bond, this is also very important for the exam tomorrow, because I think he might ask something for regarding semi-annual. So it's a 100 rupees par value bond, 114%, matures after 10 years, and interest is payable semi-annually. Okay. So semi-annually, what you can do is just break the period of 10 years into 20 periods. So instead of using 10 years, then think of it as 20 half years. Okay. And instead of the coupon rate of per annum as 14%, you can just break it as 7% per half year. And then the entire calculation is the same. Similarly, your required rate of return would again become 7.5 per half year. So whatever is the breaking, like if you're breaking the, let's say, if it's paying you every month, in that case, you'll have to make this, instead of 10, you'll have to multiply this into months. So it will become 120 months. The rate would become 14 divided by 12 per month. And this would become 15 divided by 12 per month. So rest of the calculation remains the same, just the number of columns gets added. I'll just show you the calculation over here. So as I said, instead of 10 years, you just have to assume it's 20 half years, and rate of interest. So you'll get on the coupon on 100 rupees, you get instead of 14. So you'll get the 14%, but essentially you're getting it 7 rupees here, 7 rupees here. So that's how you calculate it. This is the present value factor for at 7.5% every year. That is also very easy, and just then multiply and you add it up. So you can see it's the value of the bond is 94.90. Got it? So I think it's easy. Just just remember to break it up into the number of months or number of quarters or number of half years. Okay. Question 6 was important. Question 6 was regarding a taxation element where so I'll solve question 6 in front of you because I know a few people face some issues with question 6. Just move this down. Okay, I'll solve it here. Okay, so what question 6 is saying is, let's say you have a bond which has a coupon rate of 12%. So on rupees 100 bond, so it says par value is 100 and you pay 70 rupees today, that bond. Maturity is 10 years and coupon rate is 12%, right? So normally what would happen? So on a 100 rupees bond, your year 1 to 10, right? So on the first year, you would get 12, 12, and you'll get this for 10 years. And then on the 10th year, you'll get 100, right? So this is what would happen normally. Now, let me just split up this 10 into 2 parts. So that's why I can show you the calculation easier. I'm just splitting the 10 years into 12 for the coupon and 100 for the redemption value. Now, here it says that your income tax is 30% and your capital gain is 10%. So now income tax is on any kind of income and capital gain tax is on the capital appreciation. So what is capital appreciation? It's basically you purchase something for 70 today and you're selling it after, like let's say you invest 70 today and you get 100 rupees for it at the end of 10 years. So that capital appreciation from 70 to 100, that 30 rupees appreciation is called the capital gain. And you pay tax on the capital gain. You don't pay tax on the 100 rupees that you earn. You get, because see, you're not earning 100 rupees. You invested 70, you're getting 100. So in the between, whatever the gap is called the capital gain. So that 30 rupees gap is your capital gain, and you have to pay 10% tax on that. So 10% tax on that essentially means 3 rupees. So 30 into 10% is 3 rupees. Okay. So let me write the tax figure here. So this is your income. This is your tax, and this is your net income, right? Feel free to write this in the exam as well. I think it'll be easier for you to visualize instead of directly writing the like directly writing 8.5. Okay. Okay. So on normal cases, you get 30% income tax. So it's 30% of your income, and you'll get that. You'll have to pay that tax on your coupon interest. And for the income in the capital gain, you have to pay 3 rupees. So how you get 3 rupees equal to 100, bracket 100 minus 70 divided by or into 10%. So 3 rupees. Now you reduce that equal to this minus this and copy that entirely. So that is your net income. Now on that income, you use the present value factor. In normal cases, here the question asks me to calculate the post-tax yield from yield to maturity. So initially, how much I had paid? I had paid rupees 70 for that. Okay. So if I calculate the IRR of all these things, I should get. Now the issue that will come if I directly use IRR formula here is that this will, like when I use IRR formula, it will assume that this is the 11th year. So I have to add these two up. So the total is 105.4. So equal to IRR, and then go up, get the entire thing. So it comes to 14%. Okay. So the yield to maturity is of that investment is 14% after tax. If I had to calculate the yield to maturity of that investment before tax, let's see how much it would have come. So if I had calculated that, let's see, equal to IRR, go here, Then let me make this 112 equal to IRR. Always make sure your investment is in negative. That way, the IRR will come. So see, post-tax, post-tax it's 14% and pre-tax it's 19%, right? So there you can see the difference because of the taxation, right? That's done. And the last is also again a very similar question. A bond has a par value of 100, matures of 1000, matures 7 years. There is coupon rate of 13%. Interest payment semi-annually. Appropriate. What should be the bond? Okay, so this is very similar to the fifth question. I think you guys can try these questions again, and you should be fine for as far as bond valuation is concerned. Okay, so that's it for the bond valuation. There are other concepts regarding bond valuation, like sometimes there are some convertible bonds. Okay, so some convertible bonds are those bonds which are converted to equity after a period of time. So let's say I issue some bonds today for 100 rupees, and I tell you that after 5 years these bonds will become converted into equity shares. So there are bonds of those kinds, but let's not cover this here. That's not in the part of the syllabus. And yeah, that's it. I hope this is it for bond valuation. Next I'll move to equity valuation, which is I think simpler and along the same line. So just thank you for watching. Meet you in the next video, and yeah, best of luck. Stay alive.